Hello and welcome everybody to the second course of the MMXM Trader, which is his personal approach. So first and foremost, all credit goes to Michael J. Huddleston, aka the Inner Circle Trader. My name is the OTE Trader. I will be narrating this course. Now let's start off with a quote I really like. If you can't simplify what's complicated, you do not understand it deep enough. And that was a fact for the first course, and it will be the same for this one. So this is a continuation of the MMXM Trader's first course, the bread and butter approach. The bread and butter approach made the concept as a whole easy to understand, and they had some high probability models. And this course will be about the personal approach from the MMXM Trader. So what I want you guys to do is a few things what we've got over here. I want you to take notes first and foremost, and after each video review your notes. That's important. Secondly, backtest the concepts and put examples down in your note-taking app before moving on to the next video. This will be key. And then forward testing, as always, journal your trades, wins and also the losses. And this is very important so you can see what you actually did right and what you actually did wrong. So the MMXM Trader's personal approach. We've got a variety of topics. Just had a little bit of an introduction. We're going to be talking about the higher time frame over here. We'll simplify how to approach that. Reading the order flow, also very important to be in the higher time frame order flow and lower time frame order flow. Order pairing, we're going to be talking about price ranges, how the market makers actually move price, right? The silver bullet, MMXMs are swing points, going to be key as well. And then the double purge, an eye opener to liquidity. And at the end, we'll be talking about how to time your trades and entries and talk about ICT's silver bullet. So let's start off with the first topic, which is the higher time frame. Now all the heavy lifting comes down to two factors, stacking probabilities and good risk management. Why? Because nothing is 100%. So the goal is to keep it simple and don't overcomplicate it. Analysis paralysis is a real thing. Higher time frame bias is the foundation to profitability. So everything falls into place once you are aligned with the higher time frame institutional order flow. And a very old saying in the trading world goes, the trend is your friend, and that is very, very true. Right, so we're going to be talking about higher time frame, and we start off with monthly to weekly to daily. So when we start off on the monthly chart, if the monthly chart is clear, then the weekly and the daily chart will be clear as well. If the monthly chart is not clear, then we drop down to the weekly chart, and if the weekly chart is clear, then the daily chart will be clear as well. Now, if the weekly chart is not clear, then we drop down to the daily chart to see if it's clear. If the daily chart is not clear, then we simply just stay out until the daily chart is clear. Now, what are we going to be focusing on? We're going to focus on 4 topics here. We're going to be talking about premium and discount, which is the dealing range you're working with. Then we're going to be talking about external and internal range liquidity. And you can check YouTube if you have not seen the video. It's on the MMXM Traders YouTube. Then thirdly, we'll be talking about higher time frame SMT. And fourth, we're going to be talking about the change in the state of delivery and or a market structure shift. So this is our higher time frame protocol, right? For a bullish scenario, we want to have a bullish draw on liquidity. Then always mark out your premium and discount of the range, right? We want to be in discount of that range. Then look for a internal range liquidity pool for our draw to go higher into a external range liquidity pool. Inside that internal range, in discount, we need to see SMT form. This is very important. Now, on that swing low, right, in that discount level, we want to see it wick below, and then the body close inside of that previous candle. And for a bearish scenario, we want to have a bearish draw on liquidity. We want to be selling in premium, so always mark out your premium and discount of the range. Then we want to hit that internal range liquidity pool to target that external range liquidity pool. And inside that internal range premium level, we want to see SMT form. Now, also with that swing high formed, we want to see that candle wick above that previous candle and then close inside of that previous candle's range. Now over here we've got a crude depiction of a chart. We've got the line chart over here. What is important? Like firstly we talk about the premium and discount of the range. We've got a higher time frame old high or a fair value gap here, and a higher time frame old low or fair value gap there. Now we wait for price to come back into discount if we want to be a buyer. And what is going to be key is the SMT that forms within that internal or external range liquidity. It can be formed either on this low or on this low, but it is key that there is SMT formed on that higher time frame key level for the change in the state of delivery and that market structure shift. If there is no SMT, there is no opportunity. Same thing over here. We've got a bearish schematic, right? A higher time frame old high or a fair value gap, which is either internal or external range liquidity. So if price hits that, we want to see that SMT form within that key level. It's either on this high or after we go into sell side of the curve. And the SMT that forms after we hit that higher time frame key level is key for that market structure shift, and that makes it way more high probable. Right, so we got a GBP USD monthly chart. So we start off with the monthly on the higher time frame, right? From monthly to weekly to daily. So let's see what is happening over here. First of all, what are we gonna do? We're gonna mark out our premium and discount, right? That's important. We want to know, are we in a premium for sells or are we in a discount for buys? What is happening over here? We have to look for external or internal range liquidity. We've got that fair value gap, so we're in a higher time frame key level, right? Now, in this internal range liquidity pool, we want to see a rate on external. We've got a swing high over here, and then we can actually see this monthly candle rates this external range liquidity. Now, after external range liquidity, what are we going to be looking for? We've got a little eye over here. That is internal range liquidity, right? So if we map out that fair value gap, that is going to be the draw on liquidity after we take out that external range liquidity. We started on the monthly, now we're going to drop down into the weekly chart. So what is happening over here, right? We've got that monthly external range rate over here. We've got that draw on liquidity, which is the monthly fair value gap. Now what are we going to be waiting for? SMT, right? The SMT will be key to see when that change in the state of delivery happens or that market structure shift. You can see over here, we've got this bullish candle rating an old high, and then this is important, the bodies of the bearish candles need to close below that up close candle which rated that external range liquidity. Now this is a high probability order block. Why? Because we took out external range liquidity, right? So we soup the high, and the SMT confirms that this will be high probability. We've got a weekly fair value gap over here, right? So we have a POI once we trade below this bullish candle, so the change in the state of delivery has happened. Now we want to find an entry point, right? Where are we going to be looking for sells? That will be in an imbalance which has been created after we closed below that change in the state of delivery candle. So now we have our monthly, we know what our weekly looks like. Then we dive into the daily time frame. Where are we going to be looking for those opportunities? Again, change in the state of delivery, right? We run an old high, the SMT confirms it to be high probability. Then we see a break in market structure down here. And again, go back to that weekly chart, right? The weekly fair value gap, remember. So how do we map that out? We know the change in the state of delivery happened on the weekly, which is this move down over here. We left that weekly fair value gap, that internal range liquidity pool. Now, where are we going to be focusing on for our trades? We want to see if we can get in this internal range liquidity, which is also premium of the dealing range. So we've got a GBP-CAD monthly chart. We're going to do exactly the same as we did with the last chart. We start off with the monthly time frame, right? Then we dive into the weekly, and then we go to the daily to see where the opportunities lie. Now, what do we have over here? Premium discount, first of all. Very important. We want to know if we are in discount or in premium. Focus on that internal to external and external to internal, right? So where did we rate external liquidity? We've got this high here on the monthly, this swing high. We can see price soups above it and then starts to decline afterwards. Now after, again, external range liquidity, we want to be focusing on an internal range liquidity pool. So where do we have that? We've got a little gap over here. right? So that is the draw on liquidity after we take out that external range liquidity on the monthly. And there you have that little fair value gap over here, which is the draw on liquidity. We started off with the monthly and we're diving into the daily right now to get a little bit of a clearer picture. We've got that monthly external range and we've got that monthly internal range, which is the draw on liquidity. And also notice how we have some clean lows here, right? Just at the monthly fair value gap, which is also a nice target to be going for. Mark out your premium and discount as always. So we want to wait after that market structure shift or change in the state of delivery that we're going to go back into premium and then look for important SMT, right? That SMT confirms that market structure shift or change in the state of delivery. So we'll mark out the SMT right now. We've got SMT on these highs. So once we start to close below those up close candles, we can assume price wants to decline lower and lower into that internal range liquidity pool. Now we have confirmed that the market structure shift or change in the state of delivery is high probability. Where are we going to be looking for an opportunity? After that SMT formed on these highs here, right, we have a daily fair value gap left behind. So immediately your eye should go for that liquidity pool to continue down its trend lower. Now over here we've got a higher time frame chart, which is GBP-CAD weekly chart. We can clearly see higher time frame is bullish, right? This is a nice uptrend. Now what makes it a higher probability that we're gonna continue up higher? As always, SMT, right? SMT is very important in continuation or reversals. Now after that SMT has formed, we're gonna be looking again for premium and discount. Step number one, right? You can see this low until this high is our current dealing range, and we want to be a buyer once price hits discount. So zooming in a little bit over here, right? Once price comes back into discount, we also run a swing low, which is here, right? Down here. Run that low and then it starts to trade up higher again. We've got that external range liquidity up here. So what are we going to be focusing on? So on the weekly chart, we ran that low into discount, right? And now we're going to go into the daily time frame to see if we can form some SMT to confirm that market structure shift, right? We've got SMT on this low down here. Swing high up here. Now, because we had SMT on these lows, once we break above it, this market structure shift is higher probability. And after we had that market structure shift, we've got a change in the state of delivery as well. We've got a bullish order block formed, and you can actually see once we break structure here, you can see price dips into that order block, right? The wick is also part of this order block, as well as the body, and we can see price dips back into that order block and continues its path up higher. So we've got that weekly chart on GBP-CAD again, right? Remember, swing low ran into discount, important. We want to be hitting discount before we move up. Discount and premium levels, what are we going to be focusing on afterwards? That internal range liquidity pool, right? So price comes back into this internal range liquidity pool over here. And then what are we going to be focusing on after we hit internal range? That SMT again, right? That confirms that is most likely a high probability area where price will be reversing from. So we hit that internal range liquidity. Once you hit internal, you want to focus on external afterwards, which is this old high up here and these highs up here, right? So let's dive in a little bit deeper. We've got the daily chart over here. Again, that SMT is key, right? So what can we see in this little piece of price action over here? So we hit that weekly discount internal range fair value gap first, right? And see what happens over here. We have a stop hunt within that discount internal range fair value gap, which is on the weekly, right? And then we see price move up. Break of structure happens over here after that stop hunt. And again, the SMT is key here, right? We want to have that with us. Now price starts to trade up higher again, and we've got a fair value gap formed, high probability fair value gap with an order block here. And then price taps that fair value gap and continues its path up into external range liquidity. So here we have another example, right? GBP-CAD weekly chart. What are we going to be waiting for? External or internal range, right? We've got a external range liquidity rate, right? Because we have one higher, one lower, one higher. So we have a swing low here. That low gets rated. And what are we going to be focusing on afterwards? Internal range liquidity, right? We have that fair value gap here on the weekly chart. Now let's dive into the daily chart. As always, what is important? SMT, right? So where does the SMT form? We've got SMT on these lows. So after that rate on external range liquidity and key, right? That SMT forming on that low, we can now look for buys towards that internal range liquidity pool on the weekly chart. So on the daily, there's also a swing high. So that's technically also external on the daily, but we're focusing on that weekly internal range. Now, after this SMT happened and the external rate liquidity, we have a order block formed, which is a change in the state of delivery. You can see price dips back into it after it closed above it and then continues up into that internal range liquidity pool, which is the weekly fair value gap. So now we're going to be talking about DXY. We've got a monthly chart over here, right? Step number one, as always, mark out premium and discount. Where are we coming from and where are we most likely to go, right? So we're focusing on the most recent monthly expansion, which is over here. We hit a monthly fair value gap, right? Let's go to the next slide. We've got a daily time frame over here. So we're focusing on this most recent monthly expansion, right? So what are we gonna do once we hit a higher time frame key level? We are actually gonna be using the bonds triad. So when DXY hits a higher time frame key level, we're going to be looking for that higher time frame SMT between the bonds triad. The DXY and bonds are opposing assets. So I've got the symbols over here for the 30-year, 10-year and the 5-year bonds. And interest rates are the foundation to movement in the dollar-based markets. So we've got the ZB1 chart over here, the monthly chart. We've got an internal range liquidity pool over here where price traded back into. If we go to the daily time frame, right, this is that low on DXY, right, 28th of December. We've got that monthly premium fair value gap. We can actually see the bonds are trading lower at this point in time. So that makes the dollar trade higher, right? But now, important, we're going to be looking for that high probability smart money reversal, which should be accompanied with SMT. So again, this low, right, which we just saw on the previous slide was the high on the bonds. We've got a market maker buy model going on. And then if we look at the triad, right, the 10-year, 15-year, the 10-year, 30-year and the 5-year, we've got that monthly fair value gap, right? Again, this is where the low formed and hit a key level on DXY. And we can see this high does not get taken out on this chart, but we do take out the same high on the 10-year here, and we take out the high on the 5-year. So this makes the higher time frame macro even more high probability. Now that we went over the higher time frame, let's go into reading the order flow. Now, first of all, we need to determine in what type of market profile we are in. So we've got three types of market profiles. We've got a bullish market profile, we've got a bearish market profile, and we've got consolidation, which is sideways price action. Now, how do you identify a bullish market? We can spot a couple of things on the chart which can aid us in determining a bullish market. So first of all, we can see price action rejecting lows and breaking through highs. We can see those down close candles supporting price higher. So we'll be using the PD array matrix for that and disrespecting those bearish PD arrays. And how do you identify a bearish market? Vice versa, right? We'll be rejecting highs and breaking through lows. And then those up close candles will be supporting price lower and disrespecting those bullish PD arrays. Now, how do you identify a consolidating market? A consolidating market is sideways price action without any velocity. So that means price will be moving up and down in between the high and low of the range and not breaking through the high or low of that range. It will sweep external range every time and go back into the range and then fail to break outside of that high or low of the range. So let's go over a couple of examples. We've got a GBP JPY weekly chart over here. So we're gonna spot a few things on this chart to determine what type of market profile we are in. So obviously this looks like bullish order flow, right? Now what makes this a bullish market profile? We're gonna spot those rejecting the lows, right, and breaking through the highs. So where do we reject the low? We've got a low down here. We can see price action dips in it and then swiftly moves away from it. So that is a high resistance liquidity run over here, and you can see the reaction of this old low is very significant. Now we gotta break through those highs, right? And we can see the bodies are actually closing above those highs over here. So we've got a rejection of the low and breaking through the highs. So next we're going to use those down close candles, right? Down close candles should support price higher when you are in a uptrend, and you can see that over here. If you've got a bearish candle formed, price trades above it, then back into it and using it as a support level. Same with this one. Down close candles are being formed, price trades above it and will be using it as a support level. And you can spot more of those candles as well. We've got one here, we've got another one here, and then once it pushes up, we form another bearish candle here, which gets tapped in and then trades away from it. So I want you to focus on this piece of price action over here, right? What is happening over here? It's the same thing that happens over here. We're rejecting the lows. You can see the body closure over here is very significant, right? We have the same thing over here. We're poking below that low, but the bodies are still not closing below the lows. So this is breaking the highs as well. Bodies closure above again, and then you can see price keeps pushing up and up and up. Zooming in a little bit more, right? GBP JPY weekly chart breaking through the highs with the bodies, right? Rejecting the lows as in the previous slides. Now we're going to mark out our premium and discount of the range. So we only want to be looking for longs once we enter that discount of the range, right? We know it's rejecting the lows, so we have the start of our dealing range over here. Then we rate those buy side liquidity, and then we form our new dealing range. So we only want to be looking for longs once we go into discount. Now we are in discount, right? And we will focus here on a daily time frame when going long. So we're going to be looking for bullish signatures at this reversal. So let's hop into the daily time frame from GBP JPY. Again, that weekly low that get rejected, right? And we're breaking through the highs, and then price is slowly coming down into discount, and over here we are in discount. So now we need to look for signatures in price action to validate our long idea, right? Now what is super powerful? Every time we need that SMT, right? So we've got SMT formed on this swing low down here with this swing low down there, and we can actually see the same thing happening over here, right? Rejecting the lows and breaking through the highs. You will see the same thing happening in this piece of price action, right? Breaking through the highs and then rejecting the lows down here. So that's a very good indication, especially with that SMT over here, that we're going to continue up higher. Now, what are we going to be using after we see those lows rejected and us breaking through the highs and that SMT being formed? We're going to be using the PD array matrix, right? We want to see those down close candles support price higher. Over here, we've got another rejection of the low. Where does it occur again, right? We've got it here again, rejecting the low and then pushing up again. Do you see another one? Right, we've got another one over here. So this keeps happening in an uptrend. It will rate those lows and then keep pushing up. And once you see those imbalances form as well, that's also a good indication you are in bullish order flow. Now let's outline all those down close candles, right, where price has been supported. So first of all, over here it starts out, but the high probability starts over here once that SMT is formed, right? We're rejecting the lows, changing the state of delivery over here, closing above that down close candle, and we can see every piece of down close candle will support price higher. Again here, rejecting the lows, taking out that short-term low here, and then tapping in that key level, right? It's a down close candle, so this makes a high probability turtle soup as well. Price starts pushing up above this candle again, so we have another change in the state of delivery here, and then we see the next candle dip into that down close candle, which should support price higher. So now another thing we can look out for, right? The strong rejection of a low. You will most of the time will see that with a wick. So it will wick through that low, but the body closure will still be above that range. And you can actually see that because we're in an uptrend, we have a strong energetic close above this high. So the bodies of the candles are closing above, while rejecting the lows happens with a swift wick, and then closure will be inside of this range. Same over here, we've got this low. We can see price has a strong rejection over here, not closing below that low, and vice versa. Over here we close above that high, right? So we are energetically closing above that high is an indication of a bullish market profile. So we've got a Euro USD daily chart over here, and now we've got buy side and sell side of the curve outlined over here. And we can see the same thing, right? We want to see energetic closes above old highs, and we want to see those rejections at the lows from the buy side of the curve. And we can see that actually, right? We have this rejection of the lows, and then you see that swift move up. Same thing over here. We're closing strongly above these highs, right? We have a short-term high here. We're closing above it, changing the state of delivery, using those down close candles for buy side of the curve to keep pushing up and up and up. And we have the same thing over here. Now, you might be wondering why we're not supporting this one, right? You always have to be aware, where are you in the range, right? This is a swing low to a swing high. So we need to go to discount before we can determine that change in the state of delivery being more high probable. And now if we go to the sell side of the curve, the same thing is happening over here, right? We have a rejection of those old highs, bodies closing below that old high, a strong reaction, and then we have a change in the state of delivery over here. Again, common price comes back into it. Up close candles should support price lower once on sell side of the curve, and every time you see a swing high rated with that velocity, right, it's rejecting it and then breaking down lower again. Here another order block, and same thing happens over here again, just like here and just like here. The rejection of that high, you can see where the bodies are closing, right, not above it. So no strong energetic close above, but rather a wick and then a closure below it. And now we have those up close candles again supporting price lower, lower, lower. Same thing happens over here. Another set of up close candles supporting price lower and eventually cleaning out all the sell side liquidity. Now let's talk about a consolidating market, right? It's sideways price action. So over here you can see the price is clearly stuck in a range. We've got this swing high over here and then the swing low over here, and this is a 4-hour chart of USD CHF, and you can see every time it stays within the range. It doesn't go below this old low or above this old high. So you can definitely see it is sideways price action. Now how does that look like when we go into external and back into the range every time? If we mark it out over here, right, we have our premium part of the range and our discount part of the range. We can see every time a high gets rated, it goes back into the range, right? It fails to take out a low, takes out that high again, back into the range, takes out a low, goes back into the range, and that keeps occurring until we break out of that consolidation. Now a note, because consolidation is not a bad thing, because price goes into market cycles, right? We have expansion, we have consolidation and reversals. So when price has expanded a lot, you gotta give it some time to consolidate, right? There has to be some sort of liquidity build up, and that's why consolidation is not a bad thing. So that concludes reading the order flow. So let's hop on over to the next topic, which is order pairing, and we're going to be talking about price ranges. Now the foundation of trading is order pairing. Pairing buy stops up with sell stops or sell stops with buy stops, and that is all the market does. An obvious and significant high to low in the market where sell stops rest below the low of the range and buy stops rest above the high of the range. So that means in bearish order flow, we look for the market makers to run stops at the high of the range by accumulating those buy stops so that they can move price down to the low of the range to pair the buy stops up with the sell stops resting below that range. And vice versa, in bullish order flow, we look for the market makers to run stops at the low of the range by accumulating sell stops so that they can move price up towards the high of the range to pair those sell stops with the buy stops resting above the range. Now, trading with ranges in the direction of the higher time frame order flow. When we are bullish, look for the range low to range high, and then you can accumulate more longs around the 50% level. And when bearish, look for the range high to range low, and you can accumulate more shorts around the 50% level. Now, when you're trading with ranges against the higher time frame directional order flow, you take profit at the 50% of the range and with internal range liquidity. So over here we've got a crude schematic of a range, right? We've got a range high over here, range low down here. Now think about the order pairing again. we want to pair up those sell stops with the buy stops, right? The sell stops are resting below an old low and the buy stops are resting above the range high. Now we want to pair it up on a key level, right? We've got this discount array over here. We can see sell stops are being accumulated, hitting that higher time frame discount PD array, and then price pushes up and pairs up those accumulated sell stops with the buy stops resting above that range high. Over here we've got an example. We've got a Euro USD 5-minute chart. Now let's go over this entire chart and build the narrative of what is going on over here. First and foremost, we've got our drawn liquidity, which is higher, right? We've got a nice line over here. We want to trade towards that line. So New York midnight open, always draw out your midnight open line, the daily open line, right? We can see London session trading into Asia session lows. So we're removing the sell stops from down here. So that is already gone, right? So there can be buy stops above this range high. We can see prices slowly moving up. And now when we are trading New York session, we always want to be buying in discount after the low of the day has been created, right? So we wait for that range high and range low to get created. So we've got our low down here, up into the high. We draw out our Fibonacci so we know where discount and where premium is. We can see the OTE levels over here. We've got a nice discount array, this fair value gap, right? And then spot this range low and this range high, which gets created before hitting that key level down here, right? So what we want to do is pair up the sell stops and push price up higher and pair them up with the buy stops, right? So that is order pairing, and we want to hit a key level below the range low for it to be high probability. And we can see that over here we dip into discount, OTE levels hit, discount level hit, right? Range low, sell stops accumulated, and then price pushes up higher into the range high where the buy stops rest. So orders are paired from low to high. So over here we've got another example, right? We've got the Euro USD 15-minute chart. Again, we want to be sellers in premium and buyer in discount as always. So we map out our swing low here and our swing high. And we've got another high over here in the range, right? So we're going to use this high over here. It's resting just below that key level. So we always want to pair up our buy stops with a key level above it, and vice versa also for a bear scenario, right? We want to pair up our sell stops with a higher time frame key level below it. And we can actually see that happen over here, right? We're engineering liquidity. We have some relatively equal lows down here. As always, mark out your New York midnight opening price. And you can see price moves up, manipulating higher into that key level. And simultaneously, what happens over here, once we hit that key level, we are also accumulating the buy stops above that range high, right? Once that is accumulated, you can actually see the displacement happening. So there is a willingness to trade lower. So this fair value gap is going to be key to continue down lower, right? So the buy stops are paired up into a key level, that is important. Then price retraces back, and then your opportunity for sells are within this fair value gap. And in the end, price drops lower, and now we have those accumulated buy stops paired up with those sell stops resting below here. Here we got a crude schematic of a bearish scenario. So vice versa, we've got our discount and premium, right? We've got a higher time frame premium PD array over here. Again, we have a range low. This is where the sell stops are resting. Now we've got a swing high up here as well. This is where the buy stops are resting. So we want to pair up, again, those buy stops into a high time frame key level. So we're accumulating buy stops, hitting that premium PD array, and then once that is accumulated, we want to push price lower into that range low, pairing up those buy stops with the sell stops resting below the range low. So over here we've got a Euro USD weekly chart. As always, mark out your premium and discount of the range, right? So we know where we are. Are we in discount or are we in premium? Over here price moves up. This is the premium area. You can see that over here running these buy stops as well. So what is going on? We want to hit a key level, right? So again, order pairing, we want to accumulate those buy stops in a key level. So we've got this higher time frame key level, which is a daily volume imbalance, actually a weekly volume imbalance because we are on the weekly chart. So we hit that weekly volume imbalance. Now we're accumulating buy stops above an old high and hitting that key level. That is important. Where is the range low? Right, from this low up until this high. So we're pairing up those buy stops in the key level, and then we want to pair up those buy stops on those sell stops below the range low. So where is your draw on liquidity after you hit those buy stops? So let's zoom in a little. We've got a higher time frame key level to the left of us, right? We've got that weekly volume imbalance fully filled up. And what is going on over here? We've got a range low and a range high. So what happens above that range high? We want to accumulate buy stops at that range high, right? And then we want to pair up buy stops with the sell stops below the range low here. Where will your eye go, right? If we take the buy stops, we want to go for old lows. Let's say this one down here, and eventually this one down here. There's sell stops resting here. Let's zoom in a little bit. Now we're on the daily chart, right? So in the weekly narrative, we have accumulated buy stops above an old high into a key level. You can see a market maker model actually, right? We've got a fractal market maker model. We've got a bigger range over here. Price comes back into it, another accumulation phase here, and then we run those buy stops. So we can go for this low, so market maker sell model, and we got another bigger market maker sell model over here because price is fractal, right? There can be multiple market maker buy and market maker sell models within one range. So a higher time frame bullish retracement is a lower time frame range high to a range low. So how does that look like? We've got multiple retracements over here, right? So once we hit those accumulated buy stops, right, and then we want to trade lower, every retracement is an opportunity to go short, right? And we can see retracement number 3 here. We've got another retracement, and here we've got another retracement until we eventually hit those sell stops over here. Now let's zoom in a little bit on those retracements, right? What are we going to be looking for? So this is a 4-hour chart, right? Previously we were on the daily chart and we were looking for all those retracements on the higher time frame, and now we're going to zoom in a little bit on the 4-hour time frame and see how we can catch an entry. So first of all, we want to be looking for the range, right? Where is the range high and where is the range low? Because we want to couple up those buy stops with those sell stops. So marking out those buy stops, right? The range high, we can see buy stops are taken. We've got the range low over here. So we're taking out those buy stops. Now let's mark out the weekly opening price because we are on the 4-hour chart, right? So the week starts off trading lower and then we run that range high. So trading above the weekly opening price, right? Same as on the daily opening price. It's ideal to sell a weekly candle above the weekly opening price. And you can see that over here, buy stops are taken out above that weekly opening price. Let's focus on retracement number 2, right? Where is the range we need to trade from? If your eye went to this part and to this part, that is correct, right? There are buy stops resting above these relative equal highs. You can see that retracement on the daily taking out those buy stops, right? So we're accumulating buy stops over here, and then we have sell stops resting on the range low. Again, mark out that weekly opening price, see where the retracement happens, ideally above the weekly opening price, pairing up those buy stops, and then the rest of the week can decline lower. So if you're unsure where the weekly candle might draw into, you can wait for a retracement on the daily, right, taking out buy stops, and then the rest of the week should be clearer for your draw on liquidity. Retracement number 3, again, try to spot where the range high and where the range low is. Right, your eye should go to this high over here and these lows down here. Again, at a high, buy stops, right? We can see that over here. Buy stops accumulated, and now we want to pair up those buy stops with the sell stops. Marking out the weekly opening price, again, we want to be a seller on the higher time frame above the weekly opening price. So we're pairing up the buy stops up here, and then price declines lower, and this is that daily retracement, right? On a weekly chart, the daily retracement, and then you try to catch this move down, pairing up the buy stops with the sell stops. So over here we've got a monthly chart for ES, right? First of all, draw out your premium and discount. As always, we need to know where are we in the range, and key thing to note, we want to see SMT, right? So we have SMT on this low and this low. So we know there is a high probability that we are gonna trade higher from here because we hit a internal range liquidity pool, right? That monthly fair value gap over here. So how does that look like on a lower time frame? Let's head on over to the daily, because that is a lower time frame than the monthly. It's again premium and discount, right? This low up until this high. We want to be looking for opportunities once we hit the discount of the range. So we can see that over here, right? We've got another SMT formed, so it makes it even more high probable we're gonna trade up higher. Mark out your external range liquidity, right? Over here, buy stops are resting above here. So we want to go external, but we can go from internal to external. So if we zoom in into the 1 hour chart, how does this look like, right? We've got that external range liquidity where those buy stops are resting. Just like in the previous slide, right? This is on a 1 hour chart. And then we have that fair value gap on the daily time frame over here. So how are we going to look for an opportunity? Ranges are fractal as well, so what happens on the daily, monthly, can also happen on the 1 hour, on the 15 minute. So now we need to spot our ranges, right? So first of all, what happens in this whole narrative? We are aiming for the external range liquidity up here, but we want to pair up sell stops before we go to those buy stops, right? So over here, we take out this all low, which means we are accumulating those sell stops to pair them up with the buy stops above here. Where does the opportunity lie? Right in the retracement, just like we showed on the daily chart earlier. Now we can do the same thing on the 1 hour chart. So that, what do we notice over here in this retracement? Right, we've got a range again, right? Sell stops resting below that old low, and we want to pair up those sell stops with the buy stops on the range high. So fractally, the same thing is happening over here, right? On the higher time frame, it happened from old high to old low, and now here the same thing. We're accumulating those sell stops for pairing it up with the buy stops. Zooming in a little bit more. As always, mark out your daily opening price. Ideally, be a seller below daily opening price and a buyer above it. And we can see below daily opening price, sell stops get accumulated on this old low, and then we're pairing it up with the buy stops above that range high. Now we just covered this little retracement over here, right? And what do we see over here? Do we see something similar happen? If your eye went to this low and then up until this high, that is a nice spot, right? We've got a key level again, and then we want to pair up sell stops in a key level to go to the buy stops on that range high, right? So zooming in again, right? We've got those sell stops down here on the range low. You see that accumulation of sell stops over here, breaking up higher, and then we are good to go higher. We're respecting those down close candles as well, right? Using the PDRA matrix, what we learned in the previous video on how to read the order flow. And once we accumulate those sell stops, we want to pair it up with the buy stops, right? That's above here. So now let's talk about counter trend trades and small scalps. And we're going to be specifically talking about the MMXM Trader's Twitter model, the X model. So here we have the tweet, right, outlining what the exact model is. We want to see a previous day high or low, that is an external rate liquidity pool, into a 1 hour bullish or bearish fair value gap, which is internal range liquidity. Then we wait for a 15-minute market structure shift with SMT and only short above New York midnight or long below it. Right? That is a complete model. So now let's dive in a little bit deeper on how to use that. So first rule of the Twitter model, the X model, right? We want to see external range liquidity purged first, which is the previous daily low or a previous daily high. So in this occasion, we're looking at that previous daily low over here. Now, what are we going to be looking for? Our range, which would be 50% of the range, right? That's what we want to target. We're going to be using previous daily high as that range. So previous daily low rate, and then we're using this entire candle as our dealing range for our take profit into internal range liquidity. So we'll mark out the 50% level, that's over here in the middle of the candle. And then we'll zoom in onto the 16-minute chart, and we're going to be looking for that 1 hour fair value gap, right? That is the target. And it has to be at or below 50% of the range. and that is where we want to take profit. So we're not holding until previous daily high. This is a counter trend trade or a scalp model. So we're aiming for 50% of the range. We've got that fair value gap over here, right? That is what we're going to be targeting after previous daily low has been ran. So zoom in a little bit more on the 15-minute chart, because here we need to wait for a 15-minute structure shift, right? So where does that occur? We first of all draw out our New York midnight opening price, right? We wait for a 15-minute structure shift. We can see that actually happening over here, right? Candle closes above this old high, and we have SMT on the low. This is key. We need to see that SMT, otherwise no trade. You can see price dips back into the breaker and order block over here, and then price pushes up willingly into that internal range liquidity pool, that 1 hour fair value gap, right? You can take profit over here already or wait until 50% of the range, but I would advise taking profits in the 1 hour fair value gap, as that is the draw on liquidity. We also have a weekly model, and this is a bearish example. So this is going to be previous weekly high run, so external range liquidity, right? Then 4 hour or 1 hour bullish fair value gap, that is the internal range, that is the draw on liquidity, right, the target. And then we're going to be waiting for a 1 hour or a 15-minute SMT, market structure shift or change in the state of delivery, and then short at or very close to the weekly open. And for a bullish scenario, we're going to be running previous weekly low, and that is that external range liquidity, then 4 hour or 1 hour bearish fair value gap as our draw on liquidity, and then we're going to be waiting for a 1 hour or 15-minute SMT, market structure shift or change in the state of delivery, and then long at or very close to the weekly opening price. So we got a nice example over here, right? We've got the weekly chart. We're going to be waiting for a weekly low or a weekly high to get rated. Over here in this occasion, weekly low gets rated. So we're going to use this entire candle, right? We're going to be using the weekly low into the weekly high as our dealing range. So we're going to be targeting that 50% level of that candle. Previous weekly low ran over here. Let's zoom in a little bit more into the 4-hour chart, right? So this is the weekly model, and we're going to be using weekly and 4-hour PD arrays. So over here, after we run that weekly low, we want to aim for a 4-hour fair value gap, which is one over here, right? So we take out the sell stops, right? Accumulating sell stops, and then pushing price up into internal range liquidity. So external to internal, and we want to take profit around the 50% level of that entire range. So if we dive into the 60-minute time frame, the 1 hour time frame, we've got the same range, right? From range high to range low. Mark out your weekly opening price. You want to take profit at or close to the weekly opening price. You can see SMT, right? That is important. We want to see SMT. We form it on the 1 hour, then a market structure break, and then price retraces back in. And if you look at order pairing, right, we can see the same thing. We can see this range low gets liquidated and then paired up with the buy stops above it. And over here, you should take profit. Now, what if there is no 4-hour fair value gap? Then you drop into the 1 hour time frame to see if there's an internal range liquidity pool and a 1 hour fair value gap. If there is not any on the 1 hour, we do not drop below the 1 hour chart, then there is no trade. So let's see over here, right, the 1 hour chart from Euro USD. Previous weekly high got rated. Over here we're breaking down lower. We've got a volume imbalance over here. So we're rating external, right, and then we want to be targeting 50% of the entire range. And then we have this line over here. This is the 50% level, and we have that 1 hour fair value gap where we want to take profit, right? So 1 hour fair value gap around 50% level, that is your take profit. Here we have another example, Euro USD 4-hour chart, right? Range high into range low, running those highs up here, and then we have a 1 hour fair value gap down here. So we want to be looking to trade towards that 1 hour fair value gap. Alright, so let's start the next topic, which is the silver bullet. Market maker models are swing points. So over here we've got a depiction of a swing high, right? So think about the previous lessons as well. Think about those buy stops resting above an old high and those sell stops below an old low. we want to take out those buy stops first, right, to pair them up with the sell stops. Now, importantly, in a swing high, we want that second candle to close inside the range to focus afterwards on that third candle being an expansion lower to go into those sell stops of that candle's range, right? So we want to pair up the buy stops with the sell stops. And again, important, the second candle needs to close inside of the range. Now, this third candle takes out the sell side liquidity already, but if it does not, we can still focus on the fourth day, which should also be an expansion lower. So the third day will be most of the time a classic sell day after that second candle closes inside of the range. So let's head over some examples. We've got a GBP CAD weekly chart over here. As always, I keep repeating it, but it's very important. You need to mark out your premium and discount of the range, right? So we have this range low over here and a range high up here. So what are we going to be focusing on? Again, think about external range and internal range liquidity, right? So we're going to see where the sell stops are taken and where the buy stops are taken. So first of all, we've got that weekly swing low external range liquidity rate down here, right? So we've got us closing inside this range, and then we also have a weekly fair value gap here. So we go from external back to internal range over here. Now going into the daily time frame, we want to be waiting for that swing, right? We want to have that second candle take out the low and then closing inside of the range. So again, we've got that SMT, we've got that weekly external range liquidity as well, which has been purged over here. And now we want to go from external into internal range liquidity. And we're going to focus on the swing over here. You can see one candle higher, one candle lower, and then the third candle is higher as well. So we have that 1, 2, and then we want to focus on the third day. So let's zoom in a little bit more. We've got that GBP CAD daily chart, right? Again, think about the previous lesson about order pairing, right? We want to pair up the sell stops with the buy stops. Again, we want to focus on that second candle closing inside, right? We need that candle to close inside of the range. So we purge those sell stops, and now we want to be focusing on the third candle, which is highly likely to be an open low and then a high and a close, right? So that would be a classic buy day going for those buy stops. Now we can dive into the 15-minute chart, and this is what we mean by market maker models are swing points, right? We see a clear sell side of the curve over here and an original consolidation of a market maker model. So this is sell side of the curve, and remember, this is day number 2, right? The second candle in the swing low, which takes out sell side liquidity, which is the start of buy side of the curve, where this is where the smart money reversal happens. So after that smart money reversal happens, right, we want to focus on day number 3, which is either first stage and or second stage of accumulation for buy side of the curve. So importantly, right, we wait for the second candle to close inside of the range, and then we focus on the third day. Now what do we map out? As always, New York midnight opening price, right? We want to be a buyer below daily opening price. And think about order pairing again. We want to pair up sell stops with buy stops, right? So we're going to be mapping out premium and discount first of all. See where there is a short-term low in discount, which we can rate to do some order pairing. And if I outline this line over here, we've got a 15-minute stop hunt over here, right? So the third day, this would be the open low and then purging liquidity and then continuation up higher, completing that market maker buy model. Essentially first candle, second candle for the smart money reversal, and then the third candle for redistribution or reaccumulation. Now where would you get in on that third day? If you did not have an order below an old low, that would be a turtle soup, right? You can also trade the PD array matrix, right? If you see this as low of the day, we have a breaker, etc. You can take whatever you want to do. You can go into the 1 minute and see if there's an opportunity in here, because low of the day should already be set over here in that swing point. Right, so for another example, we've got Euro USD daily chart, we've got SMT on the highs, right? Important. And then we have a higher time frame key level. So that's where you want those swing points to form, right? It makes it higher probable that we're going to move away from a higher time frame key level. So where does the swing point occur? Right, we've got candle number 1 over here, and then we have candle number 2 raiding the high of candle number 1 into that higher time frame key level. Now what is important after we take those buy stops and we want to target those sell stops, right? The order pairing, once again, it is important that candle number 2 must close inside of this range. That is a must. And then we can focus on the third day, which is this candle over here, taking out those sell stop in the end. So let's dive in to a lower time frame and see what that looks like. So we trade candle number 3. We want to be targeting the previous daily low first of all, right? That is target number 1, and then the candles range low of where the swing point occurred. That is target number 2. So over here we're diving into the lower time frame, right? We've got a 15-minute chart. As always, look for that range high and the range low, right? First day, and then the second day is the smart money reversal in that higher time frame key level, and from there on out we can start to look for opportunities. So the third day is actually this day over here. So we got a market maker sell model going on, right? How likely would it be that you would catch an entry in this example? And that's why we put this example here as well. Sometimes you won't get an entry and the swing point will already complete the market maker model very quickly. So that is fine as well. We trade the probabilities, but we really need to focus on that third candle in the swing point, right? So if you want to complete the market maker sell model, probably no entry. Could be on the lower time frame, maybe on the 1 minute you can find an entry here. But those are just the probabilities. Right, so now let's dive into time frame alignment for SMT and our continuation purchase, and then how to take an entry. We've got 4 models over here, 4 swing models. We've got a monthly swing model, and we're going to be looking for 4-hour SMT or continuation purge, and then 4-hour or a 1-hour change in the state of delivery order block, or 50 to 62% retracement level. Then we've got a weekly swing model, a 1-hour SMT we're going to be looking for, and or continuation purges, and then a 1-hour or 15-minute change in the state of delivery order block, or 50 to 62% retracement level. Thirdly, we've got a daily swing model. So then we're going to be looking for 15-minute SMT and or continuation purges, and then 15-minute and or 5-minute change in the state of delivery order block, or the 50 to 62% retracement. And lastly, we've got the 4-hour swing model or previous session high run into a 5-minute SMT and or continuation purges, and then we're going to be looking for a 5-minute change in the state of delivery order block, or the 50 to 62% retracement level. So firstly, let's start with the monthly swing model into the 4-hour SMT continuation purges. We've got a DXY monthly chart over here. So let's outline the premium and discount, right? The premium up here and the discount here. We've got that key level outlined. We're going to be focusing on that swing, right? We've got the first candle over here. Second candle takes out the low and closes inside of the range. That is important. Again, we need the second candle to close inside of the range. Then the third candle, we're going to be focusing on purging the high of that first candle. So if we dive into the daily time frame, it looks a little bit more clear, right? We've got that low formed on 8th of March, taking out those sell stops. So now we immediately turn into where do we want to pair up those sell stops, right? We want to pair them up with the buy stops on the high of the range. Now, why was this a high probability smart money reversal on that monthly time frame, right? Think back about those bonds, right? The triad, the SMT that happened on those bonds. You can see this high got rated on this bond, and then on this one we did not rate the high over here. So that makes it for a high probable smart money reversal in a key level. So we're diving in a little bit lower, right? We're going from monthly into 4-hour continuation purges. So what does that look like? We've got the monthly low sell stops being taken out, and then we want to aim for that monthly high where the buy stops are resting. We've got a break of structure over here, right? And then a continuation purge down here. So we're taking out a short-term low, purging the low, and then we want to look for continuation up higher. So again, what are we going to be looking for afterwards? We're going to be looking for a change in the state of delivery on the 4 hour or the 1 hour, and or we're going to be looking for a 50 to 62% retracement level. So what does this look like? If after we had the purge, we have a new range formed as well, right? So we can put our Fibonacci on here, and we're going to be looking for the 50 to 62% retracement level where we can take entry from. Again, we have a continuation purge here as well, right? The 4 hour lows get rated, and it happens the same over here, right? Short-term low rates those low, which is a purge for continuation up higher, hitting this breaker as well, right? So it happens in a key level, that is important. So let's go back again. What happens down here, right? So we're waiting for a monthly swing low to form, right? Second candle closes inside, and we're going to be looking out also for that 4 hour change in the state of delivery order block. This is where the highest probability order block forms. All right, so you can see that the order block is being used perfectly, and then a continuation purge happens down here. Same thing over here, right? Short-term low gets rated, so we can count that as a continuation purge. Push up again and again, breaker block up here, and then the continuation purge happens inside of this breaker below an old low for continuation up higher. So on the monthly time frame, sell stops are being accumulated down here, right? And we want to pair it up with the buy stops resting above that range high. So we're zooming in a little bit further, like the 1 hour chart over here. And we're zooming in on that 4 hour continuation purge, right? So we had that 4 hour order block over here, right? A change in the state of delivery. Now we had that 4 hour continuation purge. So we purged the low down here. Then what forms? A high probability order block, right? Because it is a purge of a low, and then we can see a push up above it. And now we've got that 50% to 62% retracement level is also a POI where you can take longs from. Right, so now we'll talk about the weekly swing model. So we're going to be looking for the 1 hour SMT and or continuation purges. So over here we've got a higher time frame chart of AUD-CAD. It's a weekly chart. As always, start out with mapping out discount and premium levels. We've got a premium order block over here, which is a higher time frame key level. And now we're going to be focusing on that swing high again, right? We want that second candle to close inside of the range. So how does that look like? We've got this candle over here, right? Range high gets rated, and then the second candle closes inside. So we always focus on the third candle or the fourth candle if the third candle did not take out the sell stops yet, right? So we're going to be focusing on that third candle from the swing high. So if we zoom in, we're going to go to the 1 hour chart, right? We're going from weekly to 1 hour continuation purges. Again, it is a market maker model, those swing points, right? And we wait for that second candle to close inside the range, so we know we had a smart money reversal already, so we can trade the redistribution or the reaccumulation phases on what side of the curve you are on. So we're on the sell side of the curve, obviously. This is a bearish example. We hit that high time frame key level, right? That weekly order block. Buy stops have been purged, so we're focusing on the third candle of the weekly swing. We can see there's a market maker sell model going on over here. We'll be looking for SMT, that is key, and 1 hour continuation purges, right? So we have SMT on these highs over here. Then price trades up, and then we can see over here we take out a swing high, a short-term high here, and it purges the high and then declines already. And we can see the same thing happening over here. We have a short-term high here, then price wicks above it, and then starts to decline afterwards. And also think about this purge, right? Think about the order pairing video. We have a rejection of the lows, right? And not an energetic close above it. So that's an indication that we're still on the right side of the curve. So zoom in a little bit more, right? Again, we wait for that 1 hour SMT to form, and then we're going to be looking for 1 hour continuation purges into the 50 or 62% retracement level. So we've got that happening over here, right? Continuation purge into premium, drops down lower, again another range formed back into the 50 to 62% retracement level, and same thing happens over here. Continuation purge above an old high, then price trades back in that retracement level, and you can see it's actually a little bit of a consolidation, but that's not a bad thing if you're on sell side of the curve, because most likely it will continue down, expanding lower, because there is no reversal from a consolidation. If you are on the sell side of the curve, right, you will not see a reversal once it starts to consolidate. So if we dive in a little bit deeper, right, we've got a 15-minute chart from AUD-CAD. So we focused on that 1 hour continuation purge, and then we can look for that 15-minute change in the state of delivery order block. So over here, we rate the buy stops, right, accumulating buy stops, and now we want to pair those up with sell stops on the lower part of the range. Then we wait for a change in the state of delivery. So we wait for that up close candle to form and trade it below. So now we have a bearish order block. You can dive in even deeper over here. We have the 15-minute chart, right? 1 hour continuation purge, another one. Up close candle over here, which is a bearish order block. 15-minute change in the state of delivery order block, right? Price comes back into that order block, into premium above the 50% retracement level, and then continues down lower. You can see the same thing happening over here. We have a set of up close candles here in premium. Price wicks into it and then continues down lower, all the way down to the sell side. Right, so let's go to the next swing model, which is the daily swing model, and we're going to be looking for 15-minute SMT and or continuation purges. So the weekly highs and lows will form with a daily swing model, and 70% of the time the daily swing model will form on a Monday, Tuesday or a Wednesday. So we've got a daily chart over here, GBP CAD. Again, as always, map out your premium and discount. Very important. Discount over here, premium over here, and then look for a high time frame key level. We've got that fair value gap over here in premium, and we have SMT making it higher probability, right? That SMT is very important. We're going to be focusing on the swing. So what happens first? We need the candle number 1. We need those buy stops rated, right? And then the second candle, I will keep repeating it, has to close inside of the range. That is important. And then we're going to be aiming for the sell stops on the range low of that candle from that swing high point. So that's where the market maker model will form. Right, so let's dive into the 50-minute time frame, right? Over here, buy side of the curve, buy stops rated in a higher time frame key level, and then we'll go into sell side of the curve, right? So we have a market maker sell model going on. Again, we want to wait for the second candle to close inside of the range, right? Which is this area over here. And then we're going to be focusing on the third candle, taking out those buys, taking out those sell stops. So SMT first and foremost important, right? We're going to be scouting for that. We've got SMT on this high from the second day, and then we're going to look for continuation purges. So we have a rate on a high here, rates on the high here, and another rate here. Put a little bit more lipstick on the chart, right? We want to be waiting for that change in the state of delivery order block, which is a high probability order block. So buy stops rated, again, SMT formed within the range, then closure below those up close candles which rated the highs, causing a change in the state of delivery, and we want to see price retrace back into premium for continuation lower. So now we see price trade lower and lower and lower. Another 15-minute continuation purge, right? We take out a swing high here, then declining further. So now essentially we're forming a new dealing range, and we want to wait for, again, price coming back into premium and then declining. So over here we have another 15-minute continuation purge, right? And then we want to be waiting for a closure below that up close candle, right? That is the high probability change in the state of delivery order block on this 15-minute time frame. You can see price comes back into it and then declines, and one more time comes back into premium and then goes for the sell stops. So let's zoom in a little bit more on that little piece of price action where the change in the state of delivery order block formed. This was the order block on the 15-minute, right? And now we're on a 5-minute chart. So let's see what it looks like. So we'd rate out the buy stops, right? Form a new range, and retracement back into premium is important, and we hit that 15-minute order block, and we can see price decline afterwards. Now the SMT over here, also important, makes this a strong high, right? Because look at the market structure. We've got a short-term high and then an intermediate term high formed over here, as well as one over here, because price drops down lower and forms another short-term high here, back into OTE levels, right? Back into the retracement levels, and then declines down lower. So another example here on the 5-minute, right? 15-minute takes out that high, and then again we want to be waiting for that retracement back into premium. And you can see those nice equal lows down here as well, right? So that should instantly spark your interest for more shorts, because they're engineering sell side liquidity over here, and you want to be targeting that and only sell in premium. That is very important. Got another example over here, right? 15-minute continuation purge. The same thing over and over and over again. Price rates those buy stops on the 15-minute, forming a change in the stated delivery order block here as well. Price declines, and now we want to map out our premium and discount with this OTE levels, right? And then we will want to be targeting that range low. So price comes back into premium over here. It went very deep into premium, but it's still respecting that order block that formed over here, right? So that is the most important part. That's why you should always put your stop loss above the order block or the swing high point, and then it declines down lower. But there was another opportunity, because price formed another range, right? Because even though we did not take out this high, we took out these highs over here, and then we took out these lows down here, right? So we're essentially forming a new dealing range once price forms this leg down. Then you can put on your Fibonacci tool, right? And then we'll want to be selling back once we hit premium again. And you can see price comes back into premium, hangs around a little bit, and then starts to decline, and eventually takes out this range low, and we want to be targeting eventually that range low on the daily candle. And the last opportunity over here, right? We've got another purge on these highs over here, so forming a new dealing range after we took out sell side liquidity, and every time price comes back into premium and wants to sell off from there. So always wait for that premium to get hit if you want to be a seller. Right, so lastly, let's talk about intraday trading. The classic sell or buy day is day number 3 and or day number 4 in the daily swing point model. So on this, we're going to be focusing session highs to lows or lows to highs. We're going to be focusing on 4-hour previous candle runs, and we're going to be using 5-minute SMT or continuation purges after either one is swept. So over here we've got a depiction of a open low high close candle and an open high low close candle, and we're going to be focusing on that classic candle, right? The daily classic candle. So we have a classic buy day candle over here, taking out a previous session low and then expanding up higher. And for a classic sell day, we've got a bearish candle, which is an open high low close, right? And we're taking out a previous session high with that candle. A classic buy and a classic sell day are more likely to form a day with a high impact news event. So day 2 that takes the high or low in a swing model is also likely to have high impact news as its manipulation. So where do we look for entries intraday? As always, map out your New York midnight opening price, right? And above midnight opening price when bearish, and a close proximity entry. And we're going to be talking about that a little bit more in the next slide. And if we are bullish below midnight open, right? And a close proximity entry. Now, what is a close proximity entry? When bearish, take the opening price to the high of the day and then extend that down below midnight open and use one standard deviation of this. So over here we've got a market maker sell model for GBP-CAD 15-minute time frame, right? All the things outlined earlier as well. Higher time frame key level, right? Buy stops ran, and now we're going to be focusing on a previous session high or previous session low rate, and then we're going to be talking about the close proximity entry. So what we can do is after we trade higher into that previous session high, and we expect this to be the high of the day of a classic sell day. So how do we map out that deviation, right? We want to mark out our daily opening price, and if we expect this to be the high of the day in a classic sell day, we want to use this range low until the high of the day that has been formed, and we're going to be using this as one standard deviation, right? So what does that look like? we've got another box down here, right? Shorts within this range, and below this range we don't look for shorts anymore because that is lower probability. We want to be in close proximity. That's why it's called a proximity entry. Now, where do the opportunities lie if you want to short this, right? We're already expecting this to be high of the day in a classic sell day. So we're going to be looking for up close candle, resisting price lower, right? And continuation purges where you can take shorts from. So this one is still in the box here, and that's a continuation purge into the lows. Now what happens on the third day, right? We've got a previous session high, which is late New York over here, and that gets rated Asia session high rather. And then we have that close proximity again, right? We've got range high into here, and then extended one deviation below us, and then in this area, this proximity, we can start to look for shorts, right? So over here we've got a fair value gap formed. This is where you could take an entry, and then we have that continuation purge here on the 15-minute, dropping down lower, and price comes back into that proximity, right? That first deviation over here, back into premium, and then from there on you can still short it. So over here we got a Euro USD daily chart. Again, think about all the previous lessons, right? We have the high time frame buys, we've got the order flow, and now also the order pairing, very important with the swing model, right? We've got a swing low formed over here, so sell stops rated. So now we instantly know we have a range low and a range high, which means we want to pair up the sell stops with the buy stops, right? And we focus on day number 3, and just repeating again, day number 2 needs to close within the range. Now we zoom in on the 15-minute chart, right? Market maker buy model, because swing points are market maker models and vice versa. We've got second day forming that smart money reversal. The wick closed inside, so that is good. And we've got sell stops rated, right? So we're accumulating sell stops, and we want to go for those buy stops up here, completing that market maker buy model. So what does that look like on a classic buy day, right? We've got a open, a low, high, close candle. We want to rate a previous session low on the third day. So what are we going to be looking for? We've got Asia session, right? Previous session, Asia session low. We rate that low, and then we're going to be looking for M5 continuation purchase and SMT. Map out your daily opening price as always, and we want to trade below that first, right? And think about how to outline that proximity entry as well. Zooming in a little bit more, right? 5-minute time frame. You can see it a little bit clearer, more zoomed in over here. Previous session low rate, SMT on the lows has been formed. Continuation purchase happening over here. So now where is the close proximity? Again, we're starting from daily opening, right? And into the low of the day, which we're gonna outline in one standard deviation, and that's only where you should be looking for entries. So that box over here, this is the entire range where you want to be looking for longs, and you can actually see that after we had a continuation purge down here, we have a fair value gap formed, right? And then we can long from there, another continuation purge here. So that is beautiful to see. Now let's outline that change in the state of delivery order block. Same chart, Asia session low rate, right? And then we can see price trading up higher, and then forming that change in the state of delivery order block. We had SMT on this lows as well, right? So you can see price comes back in that order block. It goes pretty deep in the range, but still respects it. So it's still valid, and then we go into the retracement, right? And then we're gonna go for those buy stops. Now, if you didn't manage to get in late during London, right, there's always an opportunity in New York session. So range low to range high, right? And think about the order pairing, right? We've got a range low as well above that key level. We've seen this example before, and this is why it's so powerful. You want to pair up those sell stops, right, and pair them up with the buy stops. And we can see that over here we dip back into that fair value gap, into the retracement level, and then this classic buy day should expand higher and going for that buy side liquidity. So that concludes the swing point video. Let's head on over to the next topic, which is the double purge, an eye-opener to liquidity. Now we're gonna be going over a few points over here for the double purge. Those market makers will only move price with low resistance after they knock out both sides of the markets. Now we want to use this in the direction of the higher time frame institutional order flow and higher time frame PD arrays. And this pattern can be used for both reversal and continuations. Most important part over here is SMT. We really want to spot that SMT to make it high probability. Because why? This is where the very high probability order blocks form. And if we know what a high probability order block is, we also know where to put our stop loss above or below. So in a bearish scenario, sell stops will be taken out first and then the buy stops will be taken. And what are we going to be waiting for? Once those buy stops are taken, we want to see SMT because that is where that high probability order block and or fair value gap forms. The high which took the buy stops is very highly likely to be a protected high, and then again SMT is key here. Now in a bullish scenario, we want to see those buy stops getting taken out first, then the sell stops will be taken, and then again we want to be waiting for that SMT to form, right? Because that high probability order block or fair value gap forms once that SMT is formed. The low which took the sell stops is very highly likely to be a protected low, and again SMT is key over here. So over here we got a crude schematic of price action, right? We've got a line chart over here for a bearish scenario. We've got a line chart over here for a bullish scenario. We've got our premium key PD array outlined and our discount key PD array. So we have to approach this mechanically, right? We want to see this happen first, then that, etc. So what are we going to be waiting first? We want to see those sell stops purged, or in a bullish scenario we want to see those buy stops purged first. Now why do we want those sell stops or buy stops purged first? Think about the order pairing video, right? Revert back to the previous videos. We want to see those sell stops accumulated below an old low and those buy stops accumulated above an old high. So now that we have accumulated the sell stops, we want to think about that order pairing, right? We want to pair up the sell stops with the buy stops or the buy stops with the sell stops. So how does that look like? We're gonna purge the buy stop second over here, right? We're gonna take out that high, and now we're accumulating buy stops over here. And the key is it has to be in a premium key level over here, that PD array, and then in a bullish scenario, we want to see that discount PD array, right? Now, when both sell stops and buy stops have been purged, aka the double purge, right? Then the market makers will move the market in the real direction it wants to go with low resistance liquidity run. So now in a bearish scenario, first the sell stops, right? Then the buy stops purged, which is a double purge, and then the LRLR happens to this low. And for the bullish scenario, same occasion, we're gonna purge the buy stops first, accumulating the buy stop, pairing them up, right? Order pairing with the sell stops, and then the real move to the high happens, which is a low resistance liquidity run. Now, what is a key signature? We want to see SMT happen on that higher time frame PD array. So this is key, double purge and SMT for that low resistance liquidity run. Now let's go over a couple of examples so we can spot it on the charts. What are we going to look for, right? As always, mark out your premium and discount of the range, and specifically we're going to be focusing on this piece of price action over here. What happened in this piece of price action? So if I go to the next slide, we see buy stops and sell stops resting above the high of the range, right? The buy stops, and the sell stops resting below the range low. So what do we want to see first? We want to see those buy stops getting taken out, right? The first part of the double purge. Then we want to pair up the buy stops with the sell stops. So sell stops purged second down here, accumulating those sell stops. Now this low is highly likely to be a protected low because we already paired up the buy stops with the sell stops, right? And then continuation up is more probable. What is key? We're gonna be waiting for the double purge, right? And then we know the LR, it will happen into this high. Buy stops first, then sell stops, then we have a protected low formed, and then we want to have the real move, which is a bullish move into this high. Now, we're going to be focusing on this little fractal over here, where a large low resistance liquidity run occurs. And think about this high is the target, right, in this whole range. And now we're going to zoom in on this piece of price action, which is a fractal range. So zooming in over here, right, we want to see those buy stops and sell stops taken out, right, the double purge. Now, why do we want to have that? We want to accumulate those buy stops above that old high and then pair them up with the sell stops below it, right? Now, after we pair it up, we should have a protected low, just like in the example on the previous range, right? We have this low here, which should be a protected low. And now once we know this is a protected low, we should have a low resistance liquidity run to the highs, which is on this high, which purged this range candle. So if we zoom in a little bit more, right, we have that piece of price action over here, but only we're on a 4-hour chart, right? The previous slide was on a daily chart. Now same thing happens over here, right? We've got this range, and this is a fractal, right? We are on 4-hour right now. This was the daily high and the daily low of the range. We can see the buy stops being purged first, then the sell stops, and then we have a protected low, right? And what was key, again, mechanical approach, right? We want to see 1, 2, then SMT happen for it making a higher probability protected low, and then the low resistance liquidity run should happen into the high. So zooming in a little bit more, now that we know that we have SMT, we have a protected low, we know the LRLR is gonna move into this high. So where does the opportunity lie? We always want to be a buyer in discount, right? And we can actually see a 4-hour discount fair value gap here, which is a perfect area to take a long from. So now let's zoom out a little bit so we can clearly see the sell side of the curve and the buy side of the curve. And think about the previous video, right? MMXMs are swing points. We can actually see that we have an original consolidation here. So sell side of the curve, smart money reversal. What is key again? SMT, right? We want to see that SMT on the smart money reversal. Then price moves up again, and then we are working with this fractal range where we want to take a buy, right? So buy stops were purged first, then sell stops. Protected low, again, SMT is key. So where do you want to take a trade from, right? The 4-hour fair value gap is the high probability area where you want to be taking a trade from. Now, over here we can also see after we purge the buy stops, right, then the sell stops, protected low, you can use that order block, which is a very high probability order block because of that SMT and because it's the double purge order block. So now from here on out, you could also take a buy from the order block into these highs and then take profit above it, right? And just outlining again over here that SMT is key on these lows. So let's say you did not get in on this order block. Is there still an opportunity? Yes, right, because we have a discount fair value gap coupled up with that high probability order block. So we know because this is a highly likely to be a protected low that you can put your stop loss below that order block, right, and enter from that discount fair value gap. Right, so let's head in on the next example over here. You might already spot what kind of model this is, but let's draw out the premium and discount range first, right? This is the dealing range we're working with. We can see price closes below inside this candle, so it's likely to run this low, right? And then price dips back into discount. And now we can see the next candle takes out previous daily low. So let's zoom in a little bit more on the 1-hour chart. We all know this is the X model, right? The Twitter model from the MMXM Trader. I'm gonna dive in a little bit more how the double purge works on this specific trade, right? So previous daily low gets run first, so we take external range liquidity here, right? But what actually happens? If we zoom in on the 15-minute time frame, we've got the previous daily low rate, right? But what happens before we rate that previous daily low? First of all, we purge those buy stops, right? So we have a double purge scenario over here. So we're accumulating the buy stops above that old high, then running down lower and then doing the second purge, which is order pairing, right? We're pairing up the buy stops with the sell stops over here, run previous daily low. And what do we know about the double purge? We are creating a double purge order block, which is a very high probability order block where you can take a trade from. So we know that most likely this is a protected low, right? Because we had the double purge and then we formed that order block. Right, so let's head in on the next example. We've got a GBP USD daily chart over here. And first of all, we're gonna spot the SMT here, right? That is key. We've got this dealing range where price broke back into discount and then moved away from here. So we're going to be focusing on this low resistance liquidity run, this whole move up here. So what do we notice, right? We've got SMT, we've got a higher time frame key PD array, which is this order block, right? So we're having a key level. And what are we going to be focusing on? We're going to be focusing on that double purge, right? So now we zoom in a little bit more, right? And key thing is we're in a key level, the daily order block, right? So let's take a look at this piece of price action and see if you can spot a double purge over here. Right, we start off with this range high and this range low, right? We could see buy stops are being taken out first over here, and notice how that high gets broken through with strength, right? So that indicates bullish institutional order flow. Now we want to pair up those buy stops with sell stops, right? So we're gonna outline our range low down here, and we're gonna purge that second. Now after we purge the second one, right, the sell stops, we're gonna focus in on this piece of price action over here because we want to catch that low resistance liquidity run, right? So now we know there should be a low resistance liquidity run into the highs after we purged the sell stops. So we're going to be focusing on what happens over here. So same thing happens over here, right? It's all fractal. So we can see those buy stops purged over here. That is the first purge, right? Buy stops accumulated above an old high. Then we want to see those sell stops purged, right, on the range low, order pairing. Eventually this is the range low we want to be focusing on. So now what do we know? Once we form that SMT with the double purge, right, it is highly likely to be a protected low and there will be a high probability order block formed. So over here we've got that order block, right? We close above it, so we have a change in the state of delivery. We can see the next candle taps back into that high probability order block, right? The wick is also part of the order block as well as the body, and you can see price is very willingly trading away from that high probability order block. All right, let's go over a bearish example. Over here we've got a GBP USD daily chart. Again, as always, premium and discount, right? We want to know where are we in the range. We are high up in premium over here. We can see SMT had been formed on these highs, and now we know higher time frame will be bearish once we close below this candle, right? A change in the state of delivery. So let's zoom in on the 1 hour chart over here and see if you can spot the double purge. Again, discount and premium of the range, right? We can see those sell stops are being taken out here, so we're accumulating sell stops. Now where do we want to pair them up with? With the buy stops, right? So where is that range high? Over here. So we purge those buy stops. And now we know, because it's the double purge, right, we want to see those sell stops with the buy stops, and then the LRR move or the low resistance liquidity run should happen into the lows. Now what is key? Again, we want to see that SMT form on those highs. So after that SMT is formed, we're going to be focusing on this fractal, right? This large move down, and you can see this is low resistance liquidity because we move swiftly down without chopping too much, right? We can see that over here is chopping a little bit, and then this whole move is with low resistance. So over here we've got a schematic of a few candles, right? How does that double purge actually look like if we view it like this? We've got those buy stops over here that gets purged by the second candle. Second candle closes inside the range as well. Think about the swing point video, right? Then the third candle goes for the range low. This is where the second purge happens. So we're accumulating the buy stops, pair them up with the sell stops, and then the real move should happen, which is a low resistance liquidity run into these highs. So same case over here. This is a bearish scenario, right? We want to see those sell stops purge first. You can see this candle closes inside of the range of this candle, goes for the buy stops above it. So we're pairing up again, order pairing, right? Sell stops with the buy stops, and then the real low resistance liquidity run should happen into this low over here. Let's go over another example over here. We got a GBP CAD daily chart, right? And this is all encompassing what is happening over here. We're going to explain why this candle was a big bullish candle, right? A low resistance liquidity run over here. First of all, premium and discount, right? As always, you want to have a higher time frame key level, and then you're going to be waiting for that double purge to occur, right? We want to see the buy stops getting taken out first. You can see that over here. Then we take out the sell stops, and then we can see the fourth candle actually, right? We have a swing point over here, which happens in a key level. The fourth candle runs up higher. Why is the fourth candle running up that high? because the third candle did not take out the range high yet, right? So the fourth, you either focus on the third or the fourth candle for that range expansion. Right, so we've got another example over here. We got a Euro USD chart. Again, the double purge, right? We've got those sell side taken out first and then the buy side, and then there will be a low resistance liquidity run. And actually, this weekly candle had CPI, so we're gonna see how that looks like in the next example. So we've got that same Euro USD, only this is a daily chart, right? So we're gonna be focusing on this piece of price action. As always, start off with mapping out your premium and discount levels. Where are you in the range, right? What is that key PD array level? So we've got a higher time frame key level over here, right? We've got the daily order block and we can see price trades back into that order block, and then there is a low resistance liquidity run lower. But why was there a low resistance liquidity run lower? This was the CPI candle, right? This is a massive candle to the downside, but what happened prior, right? We got a sell stop rate first over here, right? So we're taking this candle's range. We can see the sell stops are being purged first of all. So we're accumulating those sell stops. Then the buy stops are being taken out, and then the real move happens, right? Because we have a sell stop rate first, then we have a buy stop rate, and then the real move happens, the low resistance liquidity run down into this low. And this was on CPI as well. So over here we've got an execution as well that the MMXM Trader took, and we can see that CPI candle delivering massively. So we're gonna go over a few more CPI examples because the double purge happens before those CPI releases, and we're gonna go over how that looks like. So first of all, we have a cat CPI, right? This massive candle. We've got a double purge happening before it, right? So we take out the buy stops first. Then we take out the sell stop, so we're order pairing, and then the low resistance liquidity run should happen into the highs. Same thing on the next CPI. This is a pound CPI, so we had cat CPI first, massive candle, then back into the range here. Notice we're on that order block here as well. GBP CPI candle over here, massive expansion again. But what happened first, right? We took out the buy stops first over here on this candle's range. Then the sell stops got rated, so now we know we have a double purge on this range, and then there should be a low resistance liquidity run happening to the buy side of the curve. We've got another example of where the MMXM trader executed this trade, right? Double purge, execution, take profit, another purge on the low, continuation purge, and then another expansion over here. All right, so this time we've got a Nasdaq chart over here. So we can see the key thing over here, right? We want to see SMT in that higher time frame key level, which is a daily fair value gap. So we have a double purge over here, right? We take out the sell stops first, then we take out the buy stops inside that daily fair value gap with SMT, and then the low resistance liquidity run should happen to the downside, right? Then another one over here, we take out the sell stops first, and notice how we close inside the range, right? From the previous video, the swing video, the candle closes inside, so the third candle is most likely to complete the range of that range candle. Buy stops are taken out second, so we have the double purge, right? And then a low resistance liquidity run should happen to the downside, and we can see that come to fruition over here. And so over here we've got that execution, right? Double purge into the higher time frame key level with that SMT, and then execution should be to the downside, and then take profit below that range low over here. So let's zoom in how that looks like on ES, right? This is a 15-minute chart, so we can clearly see we have a market maker sell model going on, right? We have that original consolidation down here into buy side of the curve. Now that high probable smart money reversal happens in the key level with SMT, right? Price starts to decline, and we can see price forms a range over here. So what does happen over here? First of all, purging the sell stops, right? It's the same steps over and over again. First the sell stops, then price taps into the buy stops. And again, notice how the energetic close below the lows are, right? And we can see a purge on the high, and while the body is closing below, right? So we can see it. This is more of a rejection, and this is an indication of bearish order flow. So we got a high probability order block formed, right? Because we had that double purge, and we can see that high impact news comes back into the order block, and then a massive drop occurs down into the sell side of the curve and completing that market maker sell model. Alright, so we're on the last topic already. Let's go to timing your trades and the ICT silver bullet. Now, when you are intraday trading, you want to focus on catching the expansion of the next 4-hour candle, and that is what we're going to be focusing on. So over here, we've got index futures 4-hour candles, right? We have 6 a.m., 10 a.m. and 2 p.m. And specifically, we're going to be focusing on the 10 a.m. and the 2 p.m., which are both ICT silver bullet time windows, right? Now for FX pairs, we've got the 159, right? The 1 a.m., 1 p.m., the 5 a.m., 5 p.m., and 9 a.m. and 9 p.m. But we're going to mainly be focusing on the 1 a.m. and the 9 a.m. So over here we got a crude depiction of price action. Starting off with index futures, right? 10 a.m. candle, a new 4-hour opening. We want to see a manipulation phase first into a higher time frame PDRA or previous session high or a previous 4-hour candles high. And what is going to be key is that SMT again, right? On that high, on that session low, on that PDRA, we want to see that SMT, and that is the manipulation phase, or the power of 3, right? We want to see accumulation, manipulation, and then distribution lower into that 4-hour candle. And for a bullish scenario, right, we have a 10 a.m. open, new 4-hour candle opening, ICT's silver bullet, right? We want to see it trade lower, making that lower wick on the 4-hour candle, then form SMT on either a higher time frame PDRA or a previous session low or a previous 4-hour candles low, and then the distribution towards the drawn liquidity, which should be higher. When we got a 2 p.m. 4-hour candle, right? ICT silver bullet for the PM session. We want to see a manipulation up, right? Creating that upper wick on that 4-hour candle opening into either a higher time frame PDRA or a previous session high, which could be AM sessions high, or a previous 4-hour candle high. And we need that SMT to form to make it a high probable smart money reversal. And the same for a bullish scenario, right? The 2 p.m. candle, the opening price, we want to see it manipulate lower, creating that lower wick of that 4-hour candle in either a higher time frame PDRA or a previous session low or a 4-hour candle low, and then the SMT will be key in that smart money reversal over there, and then distribution higher should happen into the drawn liquidity towards buy side liquidity. So let's go over a couple of examples. We've got the Nasdaq daily chart over here, and as always we want to be marking out our discount and premium levels, right? Where are we coming from and where do we want to trade towards? As always, we want to see a higher time frame key level, and SMT is key in this area, right? So we have a higher time frame fair value gap here, this daily fair value gap. We can see price dips into it, forms SMT on this low with YM or US30. Then think about the higher time frame video, right? We want to see a closure inside the candle. We want to be aiming back into premium with this candle formation. And let's go to the next slide over here. Zooming in a little bit more, right? We've got the 4-hour chart here from Nasdaq, and this gray box is that higher time frame level, right? So we already had SMT formed on those lows into a key level, which is that daily fair value gap. And now over here on the 4-hour chart, we also form SMT on these lows, right? So we have higher time frame into lower time frame SMT, which is a very powerful tool to be using. Now think about the opening price of the 10 a.m. candle, right? We want to see a manipulation lower into either a higher time frame key level or previous session low or a 4-hour low, right? So we've got over here the London session low. So let's zoom in a little bit. Let's go to the 5-minute charts to see what does that actually look like, right? We have the whole narrative right now. We've got that higher time frame key level, which is the daily fair value gap. We know the 4-hour candle opens up over here, right? So what do we want to see? We want to see a key level hit or a previous session low hit or a previous 4-hour candles low. And now price opens up over here, takes out London session lows, right? And we can see price declining. And we also have 3 drives down here, right? 1, 2, 3, and then we can see price breaking structure and finding support on that breaker. So this is an opportunity where you can go long. If you want to trade second stage distribution, you can also wait and see that breaker be respected for another leg up, right? And then you can catch the next PD array, and in this case that is an order block with a fair value gap, right? Very powerful combination as well. And then we can see the 4-hour candle keeps going up and up and up. So from the 4-hour candle opening, the manipulation, previous session low, and then distribution up higher, making that the power of 3 of that 4-hour candle. So over here we've got another example. We've got the ES daily chart. Again, as always, discount premium. We want to know where are we coming from and where are we going, right? So SMT is key, right? We want to have that SMT on those highs if we are looking for a bearish reversal. So we're closing below this area down here. So we're breaking structure as well. So let's zoom in a little bit more. Right, still on the daily chart, but we want to be focusing on this piece of price action, right? We've got a daily fair value gap and a previous daily high run, right? And we're closing below in the range, SMT on the high, so that makes for a high probability bearish move next. And we want to be zooming in a little bit more and see what that looks like, right? So let's go to the 4-hour. And again, like I just said earlier, if you couple up higher time frame SMT with lower time frame SMT, that makes it very high probable, right? So we have that SMT again on this high towards this high, and then we can see that 10 a.m. candle opening, right? We want to see either previous session high or a key level hit or a 4-hour previous candles high rated and then closing in the range, right? And also think about the swing point video. We see the rate on the high, so we have candle 1, candle number 2 has to close inside of the range, right? And then you can see the next candle's expansion should be towards this candle's low, and we can see the draw on liquidity is lower anyway, so that is a very clear draw on liquidity. So let's focus on this a little bit more. Zooming in, right? This is a 5-minute chart. We have a market maker sell model. Nice consolidation down here, relative equal lows. So we got a clear draw on liquidity. Price starts to accumulate, push up, and then eventually rating this high. And again, SMT, right? SMT is key in a reversal. So taking out this high, SMT, and then we're breaking down structure over here. So 10 a.m. candle, right? Opens up, trades down lower and up into that high, right? With SMT. So rating previous 4-hour high and then breaking down structure and closing inside, right? So you can see that 10 a.m. candle opening up, right? So it trades lower first, then takes out that high, which is a previous 4-hour high. And then again, SMT is key in this area, right? Then focusing on this little piece of price action over here. Break of structure down here, price trades up, takes out the high. So we have a purge on liquidity, right? Break of structure, and it leaves down a fair value gap. Then price trades down lower and creates a change in the state of delivery. So we have an order block here, and then price declines down lower and lower and lower. Now 10 a.m. we can find an entry, right? Because we develop structure properly. Now if I look at the 2 p.m. opening price, it just melts down and there is no way to catch this, and that is okay. You gotta really see your structure form as well and all the things you need, and if it just keeps melting, you're just gonna let it run. There's not always a trade opportunity with a 4-hour candle opening price, right? Or taking out the previous 4-hour high. Sometimes that doesn't happen, and then there is no trade that's set up, and that is fine. Then we sit on our hands. So let's talk a little bit about FX dollar pairs right now. The only difference right now is the 4-hour candle's timing, right? So now we're going to be talking about the 1 a.m. candle. And this is London sessions 4-hour candle, right? So we want to see London sessions 4-hour candle trade up into either a higher time frame PD array or a previous session high or a previous 4-hour candle high. And this previous session high could be Asia range, for example. Now on that high, we want to see SMT formed, right? High probability for smart money reversal, never sleep on SMT, and then the 4-hour distribution should happen down lower. Now for a bullish example, right, we've got the 1 a.m. opening of that 4-hour candle, right, the London session candle, 4-hour candle, price trades down lower into either a higher time frame PD array or a previous session low, which could be Asia session, or a previous 4-hour candles low, and then with that SMT on that low, we want to see a distribution phase happen towards the drawn liquidity, which should be higher. And for a bearish scenario, we've got a 9 a.m. candle, right? This is the New York session candle, 4-hour candle. We want to see it trade up higher in either a higher time frame PDRA or a previous session high, which could be London session, right? And then, or either a 4-hour candle high and then SMT again formed on those highs, and then price should distribute down lower. And over here we've got a 9 a.m. candle, right? That New York session 4-hour candle. This is a bullish example again, right? We want to see price trade lower into a higher time frame PDRA or a previous session low, which can be London session, or a previous 4-hour candles low with that SMT. Makes it higher probable. Again, keep repeating that. That's very important. And then the distribution phase should happen up higher. So let's go over a couple of examples, right? We've got a Euro USD daily chart over here. We're marking out our premium levels and our discount levels, which is down here. Then we've got, think about the previous lessons, right? That candle formation of the swing points. You've got this candle's low getting rated, and important that the candle closes inside of this candle's range, right? Now we know we can focus on the third and the fourth candle to reach this candle's range high. So let's zoom in a little bit. So over here we've got the Euro USD 15-minute chart, clear market maker buy model, right? Think about the daily time frame again, right? That swing formation. We can see day number 1 over here, then the second day rates the low, and importantly it closes inside, right? Over here closed inside. So once the daily candle closes above this blue line, we can anticipate the next day to go for this range high, which is that first day's candle. And where are we going to be looking for opportunities, right? We wait for that 4-hour candle opening. We want to see either a higher time frame key level hit, or a previous session low, or a previous 4-hour candles low. And in this occasion, we've got a previous London session low, right? Previous day London session takes out that low, and then SMT, right? That is key. We want to see that SMT, and then from there on out, the 9 a.m. candle opens up, right? Raise it, then break of structure, and you got a breaker over here where you can take a trade from, and that is all you need to be waiting for. So over here we've got another example. We've got a GBP USD daily chart marking out the range low down here, right? And a range high. We know we want to be targeting that range low, right? At the relative equal lows after range high gets purged. Again, SMT formed on the highs, making it a higher probable smart money reversal, and then drawing a new range over here. So we are in discount down here, and in premium up here. We have a premium order block as well. And then we're going to be focusing on this piece of price action over here, and specifically on this candle. So zooming in a little bit more, right? GBP USD 4-hour chart. We want to be focusing on that 9 a.m. candle, right? So either a previous session high, or a previous 4-hour candle high, or a higher time frame key level. So in this occasion we can see this candle, right, the 9 a.m. candle takes out a previous 4-hour candle's high and then starts to decline. So we can see the manipulation phase going up here, and then the distribution phase down lower. So let's zoom in a little bit more, because we're focusing on that 9 a.m. candle, right? We've got a market maker sell model going on, and I think this was actually CPI. So we can see a massive drop down here. Now, if the 9 a.m. candle opens up and rates that high, right, how are we going to catch this? In this occasion, we're not going to catch it, right? This happens as well. So this is just to show you that this is how the market makers book price before they run it towards a target, right? They want to have the power of 3, the double purge, and then a previous session high or a 4-hour candle high, right? That's how they book price, to smash it down lower and completing that market maker model. So not always there is a entry. Now let's talk a little bit about Asian pairs, right? We want to be focusing on 9 a.m. or the 9 p.m. candle. And Asian session pairs can be something like AUD JPY, GBP JPY, or AUD CAD, right? We want to have the JPY, the AUD, the NZD. Those are Asian session pairs. And again, we want to see that opening price, right, going up higher into either higher time frame PDRA, a previous session high, or a 4-hour candle high, and that SMT needs to be present, and then the distribution phase down lower is more probable. And same thing for a bullish example, right? We want to focus on the 9 a.m. and the 9 p.m. candle, right? Trading down lower in a higher time frame PDRA or a previous session low or a 4-hour candle low, right? And then that SMT is key for the distribution phase up higher. Right, so over here we've got AUD JPY, so that's an Asian session pair, right? We're on the daily chart over here, mapping out where should we go and where's most likely to go. And we've got our discount and premium levels, right? We've got our range low and our range high over here. You can see this range gets purged, right? And we have SMT formed on these lows. So that's a high probability smart money reversal. But what do you see in this candle formation, right? What is important over here? Right, we close inside of this candle's range. So this candle is important, right? After we rate that sell side liquidity with SMT, right, we can see this candle is closing inside of the range of candle number 1. This is very important. So we can focus on the third and fourth candle expanding up higher and targeting that range high, which has buy stops above it. Right, so over here we've got a 4-hour chart, right? And just to show you guys how the 4-hour candle opens up and where it should trade towards after we have that higher time frame narrative, right, and that liquidity purge and the manipulation phase. So we hit a higher time frame key level, right, with this 4-hour candle, and we can see that the 9 p.m. candle trades up higher into the drawn liquidity, which should be higher. So same thing over here, right? We've got the 9 a.m. candle opening. We can see it making a lower wick into a key level, which is this order block, and then it's expanding up higher towards that range high, which has buy stops above it. And over here, the 9 p.m. candle, same occasion, very close to buy side liquidity already, and it finishes off this move. So now let's talk about ICT Silver Bullet, and we're going to be removing the veil. Why does he pick these specific times, right? Now we know these are new 4-hour candle openings, right? 10 a.m. and 2 p.m. Both ICT's Silver Bullet window. Right, so over here we've got a crude depiction of some candlesticks, right? But what is important is how these candlesticks form, right? We're going to be focusing on that 10 a.m. because it's index futures, right? That is the ICT's silver bullet window. Now what happens prior to that 10 a.m. candle is key. We want to see that 8 a.m. candle low rated by the 9 a.m. candle. And what is also key, we want to see that 9 a.m. candle close inside the range of the 8 a.m. candle, so we can target that 8 a.m. candle's high by trading and finding an entry on the 10 a.m. candle, which is over here, right? We want to see that power of 3, right? Making a lower wick, manipulating, and then distributing up higher. And the same thing for a bearish scenario, right? We're going to be focusing on that 10 a.m. ICT silver bullet. But what happens prior is important. We want to see that 8 a.m. candle's high rated by the 9 a.m. candle, and then the 9 a.m. candle needs to close inside of this range. And then we know we can trade the power of 3 of the 10 a.m. candle, making a manipulation phase higher, hitting either a PD array of some sort and then trading down lower. Now for the PM session, right, the 2 p.m. candle, we want to be rating that 1 p.m. candle's low, and then important, we want to close inside of this one, right? We want to close inside of this candle, so we know we have that swing formation, and then the 3 p.m. and then the 3 p.m. candle should be a manipulation lower, but respecting this low, right? And then the distribution phase should happen upwards. Now for a bearish example, right, we want to have that 1 p.m. candle's high rated by the 2 p.m. candle, and importantly, 2 p.m. candle needs to close inside of the 1 p.m. candle, and then we can trade the 3 p.m. candles power of 3, right, manipulation higher, and then a distribution down lower. So over here we've got a Nasdaq 1-hour chart, and we're going to be focusing on that swing point, right? We can see it already over here. We want to map out the 8 a.m. candle range. We can see the 8 a.m. candle over here, buy side above it, sell side below it. So always think about order pairing as well and how those swing points form. We've got a 8 a.m. candle low rate by the 9 a.m. candle. And what is important, right? We want to see that candle close inside of the first candle over here, the 8 a.m. candle. And then 10 a.m. is the silver bullet window, right? And we want to see an expansion higher, respecting the 9 a.m. low, and then rating the 8 a.m. candle high. So if you zoom in a little bit more, right, we've got this 60-minute chart, right, the 1-hour chart of Nasdaq. We can see price action over here dipping in the fair value gap CE, which is the 50% level of that fair value gap. So let's outline the range we're trading with, right? We've got the range high up here, and then this range low gets purged, right? So what timing do we get over here? So over here we can outline this candle's range low, right? And the candle range high. So we know we want to be taking out that candle's range low first, which is the 8 a.m. candle low, right? So the ICT silver bullet is the 10 a.m. candle. We can see the 9 a.m. candle taking out the 8 a.m. candle low in a higher time frame key level, which is this fair value gap CE, right? And closure inside of this range is very important. So now when the 10 a.m. candle opens up, which is the ICT silver bullet window, we can look for a trade opportunity targeting that range high, which is up here. So how does that look like if we zoom in on the lower time frame? Over here we've got a 5-minute chart, right? Again, 8 a.m. low needs to get rated and then close inside of the range. And we can actually see the 9 a.m. candle rates the low into that key level, right? That fair value gap CE, which is the 50% level of that fair value gap. We can see because of that rate, there is a high probability order block formed over here, right? And then we want to either trade this candle here, which is not the 10 a.m. candle yet, because we want to be focusing on the 10 a.m. candle. And we can actually see this is the second stage distribution, right? So 10 a.m. candle opens up and then forms a fair value gap, and then we can take entry on that fair value gap, and then it takes out the range high because we know the range low has been rated already. So we want to be pairing up those sell stops with the buy stops resting above it. Right, another example over here, we've got the ES chart. This is a 1-hour chart, and we can focus on that 10 a.m. candle, right? The ICT silver bullet time window. We've got candle number 1, the high gets rated, right? This is the 8 a.m. candle, rated by the 9 a.m. candle. Then price closes inside of this candle, so we now know we want to target this candle's range low, and this is the focus, right? This expansion down lower. Same thing down here. We've got that 8 a.m. candle, right, gets rated by the 9 a.m. candle, and again, important, we want to be closing inside of this first candle's range. Then we know we can target that candle's low, and that is the 10 a.m. ICT silver bullet time window, so we're going to be focusing on this candle's expansion. So if you take the opening price, right, where do we want to go? We want to manipulate up higher, right, and then go down lower and distributing. And that's just like the same thing over here. We want to open up, make a higher wick, and then continue down lower. So if we zoom in, we've got a 1-minute chart actually over here, the ES 1-minute chart. Buy stops rated, right, over here, that 8 a.m. candle taken out by the 9 a.m. candle, then closed inside. And then once the 10 a.m. candle opens up, which is over here, right, trade up a little bit higher, then forming a fair value gap and breaking structure. And again, higher time frame SMT coupled up with lower time frame SMT is key and very powerful. So we can see actually the SMT form here. And now we know after we take out the buy stops, think about order pairing, right? We want to pair up the buy stops with the sell stops resting below it. And this fair value gap is the opportunity in the ICT silver bullet window, the 10 a.m. candle. So here another example, right? The ES 1-minute chart. After we run 8 a.m. candles high, right? We see the buy stops taken out, and then closure inside is key, right? Then price breaks down lower and lower and lower, forming a high probability order block over here. 10 a.m. opens up, trades into the order block still, and then trades down lower, forming a fair value gap. So there's another opportunity to get in, and then targeting those sell stops on the range low, right? Again, order pairing, accumulating those buy stops and pairing them up with the sell stops down here. All right, so let's talk a little bit about Forex New York candles, right? Normally we want to be focusing on that 7, 8, and 9 a.m. But if there is high impact news, the timing moves up a little bit. So we're going to be focusing on the 6, 7, and 8 a.m. candle because we want to see that distribution happen with the news release, right? And the same thing for a bearish scenario. We can have a 7, 8, and 9 a.m. candle formation. But if there is high impact news at, let's say, 8:30, we want to be focusing on the 6, 7, and then the 8 a.m. candle being the distribution candle. So again, always with the swing formation, we want to close inside of the range, right? As you can see over here. And then the third candle should be a distribution. And for Forex London, right, we're going to be using the 1 a.m. low getting rated by the 2 a.m. candle, and the 2 a.m. candle needs to close inside of the range, so we can trade the 3 a.m. candle, which can be a distribution up higher in this occasion. And for a bearish example, right, London session, we want to see that 1 a.m. candle high rated by the 2 a.m. candle. 2 a.m. candle has to close inside of the range, right? So now we know we can trade the distribution phase of the 3 a.m. candle. And think about it, we want to have SMT on this highs as well, right? Making it a higher probability, and the candle needs to close inside of the range. So let's go over a example. Over here we've got a range high right over here, and we've got a range low. Zoom in a little bit more, range high and range low. We can actually see this range low gets rated, right? We can see the 1 a.m. candle gets rated by the 2 a.m. candle. Then importantly, we close inside of the range, right? And then the 3 a.m. candle, which is the ICT silver bullet candle, makes a lower wick and then continues distributing up higher based on what this 1 a.m. candle provided with us, right? 1 a.m., 2 a.m. rate into closure inside of the range, so we know we need to target this range high and eventually this range high up here. So how does that look like? If we zoom in a little bit more, where do we catch an entry? So this is the GBP CAT 5-minute chart, right? And think about what we want to see with that 4-hour candle, right? We want to either see a higher time frame key level hit, or a previous session low, or a previous 4-hour candle low, and then we're going to trade the distribution up higher. So over here we can see, if we map out New York midnight opening price, right, we want to be a buyer below it. Ideally we can see this is candle number 1, right, a 1 a.m. candle. Then the 2 a.m. candle rates the low and then closes inside of the range. We're leaving a fair value gap behind after we take out Asia session low, right? So the step-by-step approach is working out over here, right? Then price distributes up higher and taking out those buy stops over here after hitting that fair value gap, and then the 3 a.m. candle, right, the ICT silver bullet, goes towards that range high over here.